Welcome to the analyst classroom. Today's we are going to teach about learn about the EPS, earning per share. There are two types of EPS, basic EPS and diluted EPS. So first, let's talk about the formula of the EPS. EPS is equal to profit available for common shareholders. Commons means equity shareholders. Divide by weighted average number of common shares outstanding during the year. Weighted average number of common shareholders means if any of the shares issue in the middle of the year, or so we need to average down all the shares and divide by profit available for the common shareholders. And profit available for the common shareholders means PAT minus any preferred dividend. PAT minus any preferred dividend or any other dividend, preference share dividends or dividend to the common shareholder. These also for common shareholders. So let's do some examples and learn more. So for example, PAT is the 500. Number of preference share is 10. Face value of 100. Preference dividend rate is 18. Number of common shares is 20. So the formula will be basic EPS is equal to 500 divided by 20, and here I need to calculate the preference dividend. So 10 into 100 into 18% is equal to 180. So here I put 180 and my basic EPS will be 16. This is our answer. This is the simplest example. We will be adding more and more details to the example. Second is PAT is 500, number of preference share issued on the 1st of April, middle of the year. Uh, our financial year assume is Jan to December. Okay, so this is the middle of the year. Preference share issued on the April 10th, face value 100, preference dividend is 18, number of common shares 20. So basic EPS will be 500 divided by 20 minus my preference share issue 10, face value 100 into 18%, and this is the full year formula. But my preference share is issued on the April 1st of April, so I need to pay him 9 month preference dividend out of 12. So my answer will be 135. 135. Okay, and my basic EPS will be 18.25. Now let's go to the next example. Here is not preference share but common common share issued common share issued on the middle of the month. This is the common share issued. So we will do the basic EPS on weighted average common share during the year. So here is the date, 1st Jan, number of share and weight in weighted average. So my number of share is 10. First April, my number of share is 45. My weight will be, this is the 12-month outstanding and this is the 9-month outstanding. So my weighted average will be 10, and here 9 by 12 into 45 means 33.75. So my answer will be 43.75. So my basic EPS is equal to 500 divided by 43.75 is equal to 11.75. Okay. Now do some comprehensive example with all the details. Okay. So here is the thing. Now stock split, bonus issue, buyback, all the corporate actions are done in this one example. So PAT is 1000. First of Jan, common share outstanding is 100, face value of 10. 2nd of April, new issue of common shares, face value 110, outstanding 120, new issued. 12th April, split. Split means you divide shares into multiple shares. Like you ask for a change of a currency to the shopkeeper. Shopkeeper gives $100, change to $10, 10 notes. This is the song. This is like split of a currency. 1 inch to 5. Your one share will be converted into 5 shares of a reduced face value 5 to 2. So this is the split. 1st of July, new issue, face value 2 of 200. Then 9th of July, bonus. Bonus means you given the extra shares as a bonus, but it will not increase your investment. It's for us, it's just like a split, but not same as the split. Two shares for every 3 shares hold. And then 1st of October, buyback, face value of 2 120. Buyback means company buys back his own shares and destroy to reduce the liquidity or to control his share from the market. So buyback face value to 120 will be minus. It reduce the shares. So let's do. So first we're gonna calculate weights. So this will be 12 by 12. This will be April to 9 by 12, and this split and this new issue July to 6 by 12, bonus, and October this will be 9 by 12. Then we're gonna check split, multiple, and bonus multiple. What we're gonna do here is to give equal weighted, we gonna multiply these actions by split and bonus before. If these actions is done before split, so in we multiply these by formula number of share after divided by number of share before. This means I gonna have 5 shares, but I have will be number of share before. I have 1 share and now I have 5. So 5 divided by 1 is equal to 5. So you can only write 5. And here in the bonus case, I'll be having the 5. Earlier I be having 3. So 5 by 3. Okay, and this is also the corporate before 5 by 3. Bonus. This is after split, so we not gonna multiply this. 2 shares for every 3 shares, so you get a total 5 shares after the bonus. And now let's calculate the weight of every action. So this will be 833.35, 833.35. This will be 750. This will be, this is the 6 by 12. This is the 166.66, and this is buyback should be minus 30, and my all answer will be 1720. This is the weighted average, and my EPS should be basic EPS is equal to 1000 PAT divided by 1720, and my EPS is 0.58. Okay. So this is the example. So now let's move to the diluted EPS. Diluted EPS means reduced EPS. EPS, if what if EPS, my earning per share. Earning per share means how much investors earn, or how much means how much shareholder company earns for per share. So my PAT, profit after tax, divided by number of shares. We gonna ask the question, what if how my EPS will reduce. My EPS will reduce basis on this. If my denominator will increase, my EPS will be reduced. So what if my number of share increase and my EPS will be down? So this answer is here. When diluted EPS is calculated, when company has a complex capital structure means if company has issued convertible preference share, or a convertible bond, or ESOPs, or a warrant. These when these actions when these securities are converted into the common shareholders, my EPS will reduce when so diluted EPS should be is equal to or less than basic EPS. It can't be greater than then then that security is non-dilutive. Okay, so my diluted EPS should be less than basic. So let's do some example. So first example is PET 1000, number of common shares 100, number of uh, convertible preference shares 1000, face value 100, preference dividend rate 6, and CFA could give you the tax rate also in this type of question, but this is just a distraction. Tax rate will be used in bonds where we gonna pay the interest before tax. Then this is the preference share dividend is paid after the tax, so we don't have to use tax rate. So if, uh, need if before calculating the diluted EPS, we need to calculate basic EPS. So basic EPS will be basic EPS should will be 1000 divided by common shares 100, and my preference share 100 into 100 into 6 means 600. So my basic EPS will be 4. Now I calculate diluted EPS. What's the logic behind the diluted EPS? What if these complex capital structure security shareholders convert their shares into the common shareholders, into the common shares? So let we check 1000 minus 600. This 600 is preference dividend. Okay, but we are assuming that this preference shareholders convert to the equity shareholders, so we don't need to divide this shareholder this 600. What CFA curriculum does is they divide, they minus and then again plus. But why we do extra step? We just don't minus this. So diluted EPS will be PET will be 1000, and my number of common share will common plus this converted to and answer will be 5. But this can't be happen because the diluted EPS should be less than or equal to BEPS. The logic behind is this, that if preference dividend shareholders earning 6% means 6 6 rupees per shares, then why they convert their common share, their preference share into the common shares and earn less. This is 4 rupees per share. Equity shareholders is earning 4 rupees and dividend shareholders is earning 6. So they can't move down. This is the logic. So this security is called anti-dilutive or non-dilutive, as I explain here, that basic diluted EPS can't be greater than basic EPS. in the exam. You could answer this type of question by just looking at the preference dividend rate or calculating the basic, and don't need to calculate this. You just calculate verbally. So the question arises, if security is anti-dilutive, is market structure is simple or complex? If my this this type of situation arise, is securities anti-dilutive, then the structure is simple or complex? Then the answer will be is still complex structure, because the complex structure is defined by these securities of convertible shares, bonds, ESOPs, and warrants. The next example is convertible bond, when we need to account for the interest rates also in and tax rate also. So I need to calculate the basic EP as 1000 and divide by 100. I don't need to calculate divide minus any reduce any PAT, because this is the paid this common shareholders interest is paid before the PAT and interest rate. So my basic EPS will be 10. This is greater than interest rate. So it is lucrative to common share convertible bondholder to move to the equity, because they are earning 6 and they are earning 10. Now we can EPS calculate the diluted EPS 1000, and if these convertible bondholders convert to the equity shareholders, I don't need to pay them interest, and my profit after tax will increase, but how much? So if you need to calculate that 100 is bond face value, 6% is 600 is the interest, and I need to calculate 600 before after tax. So 1 minus 40% I will be paying in tax. So 60% will be 360 will be my after tax interest. 360 I will add. Okay, and my share will be increased by 100 also. So my diluted EPS will be 6.8. So this is the example. So now let's move to the another. PAT is 1000, number of common shares 100, number of ESOPs 100, common share 100, exercise value is 6. So the EPS logic is, when company is in an early stage or in the mid, company issue the ESOPs, means they offer their shareholders to buy their shares at a discounted price. It is specific. This is the discounted price is earning exercise value. If my current market price or the average market price is 100, then my shareholders or my employees could buy shares at a lower rate. So it will be 60, my average market price. When we calculating the ESOPs, then we always gonna use the average market price, because closing market price of for a specific period can be manipulated. So we always be using average market price. So let's calculate the CFA curriculum have a specific treasury stock method to calculate the mm, diluted EPS of ESOPs. So let's check this first. Then we're gonna use our own method, short method. So the first step is the employee exercise money received and share issued. So exercise money received 600 will be this. I will receive 100 issue and 60 rupees. 100 issue 60 rupees, 600, and share issued will be 100. Then the next step is what curriculum is says that go to the market and buy back your own shares at the average market price by this money. So buy back own shares at average market price. So 6,000 divided by 100 is my average price, so 60 shares. Then third step is the net value. Net value means 100 minus 60, 40. So 60 you buy back, then the 40 is rest. You're gonna use into the basic diluted EPS. So DPS will be 1000 divided by 100 plus this 40 comes to here. So my diluted EPS will be 7.14. I forgot to calculate basic EPS first. So my basic EPS will be 100 PAT, 1000 PAT and 100 common shareholders. My basic EPS 10. By this treasury stock method, my diluted EPS comes to this. So we're gonna do is we treat these as a X. So we need to find the X here. So what gonna do is before doing uh, instead of doing this lengthy method, we're gonna use the we need to find this 40 by doing this amount of step. We short down with one formula is number of ESOPs multiplied by benefit benefit to employee divided by average market price means the number of ESOPs will be 100. Benefit to the employee means my average market price is 100 and I am giving him um, it is 60 rupees. What the benefit? 40 rupees. 40 rupees benefit divided by 100. This 100 divide and 40 will be my x. So direct with this one formula you calculate this 40 and do your own step instead of doing this step. The logic is same, but this is the extra step you can ignore. Okay, let's move to the another example with this short method and how much space it will take. We see my basic PS is 1000 pet. My my diluted EPS is 1000 divided by 100 plus this x. X means my number of ESOPs will be issued 50. This remember this formula 50 into benefit. Benefit means average market price minus excess value. 5 rupees is 5 is my benefit and 50. So 10. So 100,000 110 my diluted EPS will be 9.09. Okay, 25. Yes, this is the 25. Average market price is 25. So 25 into 2 and 2 into 5, 10. 25 is my average market price. So this amount of what X means, suppose that benefit to the employee shares you given to your employee as a free means this 25 20 rupees shares you 20 rupees you will receive against this. So you this is the, just like the CFA curriculum says that extra benefit money you not receive. So this treated as a free and this can't be this not increase your pet. So says you given your employee as a free rest you given as a market price then CFA method calculation is just like a CFL calculate method but it's a shorted. So let's do the last example. So with all three thing number of preference shares face value preferential. Okay, so let's calculate the first basic EPS. My 100 minus 400, 100 into 100 into 4% and 100. So my 6 6 is basic EPS. 400 divided by 100, we earning 4. So this is the dilutive. We need to calculate what which of these securities is dilutive or non-dilutive, and this and that is only we need to account for in the formula. So convertible bond 100, face value 100, interest rate 10%, tax rate is 20%. So this is the greater than our basic EPS. 800 into, so 20% is 100 into 100, 1000 to 1000 minus 20%, 800. 800 divided by 100, he is earning 8. So this is the non-dilutive. And ESOPs average market price 140. So average market price is greater than exercise value, exercise price. So this is dilutive. So we're gonna count for only these and this, not this, in the calculation of. So what we're gonna do is diluted EPS 1000 is my pet, 400 is my preference dividend, but I not paying if they convert. 100 is my common shares, plus preference dividend is also 100, preference shareholders is also 100, and my how much ESOPs will be increased. So ESOPs formula is number of ESOPs, number of ESOPs is 100, benefit to the employee 70, 140, 140 minus 70, 70 rupee, 70 is benefit, and my today's market price is 140. So my 50 goes to this. 50 is my free shares to given to the employee, and my diluted EPS will be 4. That's it. Thank you for listening, and if you have any questions or suggestion, please leave a comment below.